Hello everyone, welcome once again to an edition of Under the Macroscope, Skybound Capital's weekly podcast. And great to be joined on the podcast today for the first time by two of Skybound's research analysts. And if you think they look and possibly even sound alike, you'd be right. The brothers, Alexander and Carl Engelhardt. And they're going to be talking to us today about something that you would have heard in the investment space for quite some time, the 60-40 portfolio. It's a well-used term in the investment arena and has been for some time. But Carl and Xander have been doing some research and investigation and possibly bringing up some reasons why the 60-40 may not be so relevant. So, gents, great to have you on the podcast today. And let's start at the very beginning. What exactly is the 60-40 portfolio and why has it historically been so popular?
Thanks, Matt. Great to be on the show. So to answer your first question, is that 60-40 portfolio is simply an investment portfolio where an investor invests about 60% of their assets into listed equities and the balance, which is that 40%, into bonds. And to answer that second part of the question, why it's been so popular, is that it's actually served as the asset allocation bellwether for many years, and rightly so. It's provided investors with some attractive or decent returns and with substantially less volatility when one compares to an investment portfolio that invests about 100% in equities. However, when we consider the current low interest rate environment we currently find ourselves in, as well as the potential prospect of central banks raising interest rates as early as next year, and the impact or ramification this can have on multiple assets and fixed income in particular, following such a strategy going into this upcoming market environment can be somewhat problematic.
So I have to ask you then, why did bonds work in the past? What was their purpose in the portfolio? Listening to you there, it's obviously just having something a little less volatile than listed equities. So they had their place in the portfolio.
Yeah, that's exactly the point. So bonds essentially provide a steady and predictable income stream to portfolios. But not only that, what's made them really attractive in your portfolio is the fact that they actually offer protection in the event of an equity market crash. So how that essentially works, and it's very important for investors to understand this mechanism of how bonds have been providing their protection if you want to understand the environment for bonds going forward. So essentially bonds, well, the price of bonds is inversely related to their yield, or for instance, interest rates. And what that means, if interest rates come down, the price of the bonds go up. So an investor that has a portfolio that's 60% equities and 40% bonds, in the event of for instance, a market crash that's induced by a recession, like the global financial crisis, for instance. In that environment, the central banks will generally lower interest rates, which leads to an appreciation in the bonds price because of that inverse relationship. Now, if you have that 60-40 portfolio, or 40% of your portfolio is made up of bonds, so that appreciates in price. And that actually offsets some of the losses you make on the equity side. So what happens in that kind of thing is that you have lower drawdowns and over the long term, less volatility in your portfolio as well. So that's kind of where they fit in, yeah.
So they've been a diversifier in a portfolio. You could argue strongly that there's an element of hedge there and just providing, I guess, more consistency over a longer period of time, which then begs the question, if they were a diversifier and something that you used to lessen the volatility of your portfolio, why are we in a scenario now where bonds are less effective at doing that?
Well, I think as investors, we've actually been in quite a privileged position where bonds have essentially been in a bull market for the last 40 years. And you can see that yields have essentially been coming down gradually since 1981. Why this matters is that they've come down so far to a point now where, for instance, short-term interest rates, so interest rates of developed markets, for instance, are around 0%. On the long side, you're around 1% to 1.5% in the UK and the US. So the reason why this matters is there's very little price return potential left for bonds because they can't go much below zero in terms of having a market investors willing to participate in. in terms of what this means going forward, it means you're not necessarily going to be getting the same kind of protection from these bonds in the event of another recession or equity market crash. That's basically because if interest rates are already at 0%, where are central banks going to be able to move them to? They're going to look at other policy measures. In addition, we also have inflation pressures that have essentially built up around the world as well. And as these continue to mount, we're eventually going to see a rise in interest rates. Central banks are naturally going to start rising interest rates again in order to get to some kind of equilibrium in terms of markets. This is inherently bad for bonds. So just as interest rates come down, that's supportive for bonds. When interest rates go up, it obviously leads to a decline in the bond price. And this is something that we know, okay? Already the Fed, for instance, has just indicated that they are willing to raise interest rates next year if they have to. And this is very much in stark contrast to what they said earlier in their policy meetings when they said that they're going to raise interest rates at the end of 2023, early 2024. So, I mean, I think the reality of this is coming a lot sooner than we initially thought, and it's definitely worth considering. So if central banks enter into a rate hiking cycle now, it's going to be very painful for those that are long bonds. And these people that are long bonds now haven't necessarily experienced a prolonged period where yields have been increasing. So yeah, I think that kind of...
Yeah. Are we saying here that the correlation between equities and bonds is actually narrowing so that you're not getting that kind of differentiation that you were in the traditional 60-40 portfolio?
Exactly. I think that's one of the things that end up happening also when inflation expectations are the primary thing driving markets. So, I mean, inflation and the prospect of rising interest rates isn't just detrimental to bonds. Cole will get onto it later, but it's also something that's a risk factor to equity valuations as well. And it's as those expectations filter through that you'll start seeing the correlation between the two asset classes increasing.
Yeah, so the correlation is greater between the two, but yet in portfolio construction, you are still looking for that diversity and to get away from some of the volatility usually associated with listed equity markets. So the obvious follow-up question then, in the absence of bonds, or if you're moving away from, shall we call it, the dependence that you've seen in the past from bonds, what are realistic alternatives in this portfolio construction?
Well, I think the main point that you touched on a lot there is diversification. So that's the first thing we would highly recommend for this 40% allocation. I mean, this is the reason why I said that we're in a very fortunate position, is because bonds were almost, you could say, one of the almost perfect assets that you could have been holding over the last 40 years, because they gave you the stable income stream as well as the negative correlation in terms of equity market distress. But seeing as we're going into a completely different environment and a completely different investment paradigm, we're going to just label just a few different asset classes our listeners could possibly consider. First one being private capital, and in particular here, private debt. Now, the reason is that private debt is still offering very attractive real yields, whereas if, for instance, you look at government bonds and so on, your real yield is very much negative. On top of that, the income stream is obviously also stable. But the one thing that we need to consider here is obviously liquidity. So you won't, for instance, by investing in private debt, you're not necessarily going to get the same liquidity that you would get from the daily traded government debt. However, if you can stomach the liquidity, it's probably a good choice to be part of your portfolio. In addition, we also have property. I mean, property, you can go in its illiquid form. You can go directly, do a direct investment into property yourself. The thing is here, it does require quite a large amount of upfront capital, as well as it is exceptionally illiquid. But you can also go for its liquid form, for instance, REITs. That's another alternative, which also have relatively stable cash flows. But they also have a capital component to the investment, which can lead to quite excessive volatility, especially because they're quite economically sensitive. Lastly, it's especially an area we've done a lot of research into now, are market neutral funds. And I think the environment that we're going into now does paint quite a good picture for these, especially if you require that daily liquidity. But I won't get too deep into the mechanics of that now. But essentially, they tend to perform better in an environment of rising interest rates, and they have low correlation to both equity and fixed income markets. So, yeah.
And we are certainly heading into rising interest rate environments because you've mentioned we're at unprecedented lows, and there's only one way that it can go. But we've spoken a lot here about the 40% component of the 60-40 portfolio. Let's divert a little bit to the 60% allocation. And what are you saying that an investor should expect, given the points that you've just mentioned, in the 60% component of their portfolio?
Yeah, so we're not going to sugarcoat it here, Matt, is that basically if we're entering into an environment with rising interest rates and yields, basically what's going to happen is equities are simply going to come down, which they kind of have of late. And this is due to high discount rates being applied to value these equities cash flows in terms of today. So in an environment of rising interest rates, as well as these inflationary pressures, investors need to be very specific as to what companies they want to invest in, especially to navigate this environment going forward.
Is it worth then holding equities? And if so, what should you be looking to hold?
Yeah, so absolutely. So definitely one should include equities or listed equities in one's portfolios because it's provided some really attractive real returns for investors over the long term. In terms of what investors should look at when they're looking to invest in liquid or listed equities is two key aspects, which is typically the leverage as well as company's pricing power. So leverage is the amount of debt a company holds on their balance sheet. So if a company is highly geared or has a lot of debt on their balance sheet and we're entering into a rising interest rate environment, naturally the cost of this debt is going to go up. And this overall increases the cost of capital that these companies need to service on a year-on-year basis in order to continue as a going concern. And then if we shift over to the pricing power element, pricing power is basically the company's ability to push on these rising input costs onto the end consumers and their ability to protect profit margins. And this is obviously a very important factor when we're considering these inflationary pressures that are beginning to evolve. So taking these 2 points or considerations into fact is that basically the companies that one should avoid is ones that are highly geared and in addition don't have pricing power, because in an environment of rising interest rates, which is amid inflationary pressures, it would obviously lead to rising input costs firstly and increasing interest expense, which they need to service on their debt. And the inability to pass these on to the end consumers would obviously compress their profit margins, and that would be ultimately detrimental to their earnings as well as their share price. So in terms of companies that one should look for is what we classify as quality companies. And the characteristics of these companies are typically ones that have high return on capital employed. So are they making money on your investment, as well as obviously exhibiting pricing power, and lastly, have a sustainable competitive advantage.
So in summary, can I just ask either of you to summarize your view on the 60-40 portfolio? What I'm hearing is that the split remains relevant, but in the current macroeconomic climate in which we find ourselves globally, the makeup of the split needs to be perhaps reassessed and for alternatives to be looked at specifically for that 40% component.
Yeah, definitely. So yeah, in summary is that on the 60% allocation side, one wants to hold their position in equities, which we think is a smart idea. Definitely look at those quality companies that have the pricing power, able to push those rising input costs onto the end consumer, protecting those profit margins. And then on that 40% allocation, the fixed income side, definitely start diversifying those assets into private capital, in particular private debt, start looking at market neutral funds, as well as maybe blending some property in one's portfolio there to not let that component act as a drag going forward.
Well, some fascinating insights there. We look forward to hearing more about some of those asset classes which you continue to research. Great to have you on the podcast, both of you, for the very first time. And I know we're going to be hearing more from you in the not too distant future. Don't forget that you can download Under the Macroscope at Apple, Spotify, and the Google Podcast platform for Android. And all past editions of the podcast are available at Skybound Capital's website at www.skyboundcapital.com. Until next time on Under the Macroscope, have a great week.